So if you've got a mortgage REIT that's a lender, it might be earning interest income and take the position that it doesn't have significant contacts with the state to establish nexus. But for the most part, if it takes over a property through a foreclosure or a deed in lieu, that's going to be enough to establish nexus. While I will caveat, there are some states that have a carve out from their nexus provisions for foreclosure properties. It's a very small handful.
Joining me today is Jonathan Saltzman, Director, PwC U.S. Tax. Jonathan, thanks so much for joining us.
Thanks for having me.
Now, you were on a panel here at REITwise discussing state and local tax issues affecting REITs. When initially creating your structure and forming entities, what are some of the considerations for companies to keep in mind?
Yeah, I think there's a lot of value in being strategic when you're structuring your REIT. Certain states may favor certain entity types. For example, in California, QRS entities and LPs are not subject to the LLC fee. That's a savings of about $13,000. Not huge, but if you've got a REIT with a high quantity of California properties, it can add up. In Texas, the franchise tax has an exemption for passive entities. LLCs will never qualify as passive, while LPs will. So I think thinking about various entity types and how they might affect your tax profile is important. Also, I think it's never too early to be thinking about disposition. If you have an investor that needs to exit via share sale, it's often helpful to have that framework in place on day one, even if it's just disregarded entities that you can make a REIT election later, because there are jurisdictions that could impose tax costs for moving properties around to facilitate that or inserting new entities. For example, Pennsylvania has a really broad transfer tax with very limited exemptions. And so if you need to drop property into a baby REIT, that's going to be subject to transfer tax.
And what are some of the state and local tax issues relating to distressed assets that are currently important for folks to know?
So if you've got a mortgage REIT that's a lender, it might be earning interest income and take the position that it doesn't have significant contacts with the state to establish nexus. But for the most part, if it takes over a property through a foreclosure or a deed in lieu, that's going to be enough to establish nexus. While I will caveat, there are some states that have a carve out from their nexus provisions for foreclosure properties. It's a very small handful. From a borrower perspective, a lot of times there will be CODI, cancellation of indebtedness income. And folks may have some sort of exception or out at the partner level, right? Qualified real property indebtedness, insolvency exemptions. But in jurisdictions that have non-resident withholding on partnerships or jurisdictions that just straight up tax partnerships, that CODI could lead to real cash tax consequences or withholding, which partners may need to fund because CODI is going to be phantom income. And that's not a great outcome. Additionally, you always need to be thinking about transfer tax in distressed situations. Many states, maybe even most, have a foreclosure exemption, but it's very fact specific. It could be that a deed in lieu does not qualify while a traditional foreclosure does, or a UCC foreclosure or UCC assignment in lieu doesn't qualify for such exemption. And so in a situation where it's already sort of gone south, the parties, the lender, the borrower, didn't get what they were expecting out of a deal, it's kind of painful to then pay transfer tax just to take back an asset.
And you touched on this a little bit, but if you could elaborate, when a REIT's planning an asset or entity sale, how should transfer tax, property tax, and sales tax savings be weighed versus cost of additional diligence for buyer?
I think as tax advisors, we really got to put on our business hats, because at the end of the day, transactional taxes such as transfer tax, sales tax, whatever, it's just another deal cost. And so I think we need to weigh, what's the benefit versus what's the cost of additional diligence. But I think something people don't always think about is what's the time cost, right? Are we sort of taking the wind out of the sails of a deal if we're slowing it down and now we need to conduct all this additional diligence? The seller, the target may not have information at their fingertips. And so are we just sort of maybe not killing the deal, but really just, like I said, taking the wind out of its sails if we need to slow down for an entity sale that was originally thought of as an asset deal. That said, switching from an asset sale to an entity deal can often save a significant amount on those transactional taxes. On a larger deal, let's say a 8-figure, 9-figure deal, it could save 7 figures in taxes sometimes. Also, it could lead to more favorable outcomes from a property tax perspective, right? There may be jurisdictions that are not going to reassess you on an entity deal that might have from a property tax perspective. You're also putting less data points out into the world, which can increase NOI and increase value going forward.